Hello everyone, I'm Sebastian Y and this is Foundations of Economics. In this video we're going to talk about a few applications for the CPI. Calculating price levels by the CPI, or GDP deflator if you want, are useful for comparing dollar amounts across time. To adjust a dollar amount from year T, sometime in the past, to today's dollars, we can use the formula the amount now is the amount in year T times the CPI now divided by the CPI in year T. You could also use this formula to calculate an amount in 1 year in any year's dollars. It doesn't have to be now, but that might be the most applicable use of this formula. To illustrate this concept, let's look at the box office earnings of 4 James Bond movies from 4 different years in the past. If we look at the box office earnings, it looks like Goldfinger made the least money and Casino Royale made the most money. Those box office numbers we see in this column are measured in the current year dollars. So the $124.9 million that Goldfinger made in 1964 is 1964 dollars. That doesn't have a whole lot of meaning to us right now. We can use the CPI to calculate how much that amount of money would be in the most current dollars that we have, which would be 2019, or last year, the last full year of data that we have for the CPI. To do that, we need to know what the CPI in 2019 is, and that is 107.86, and I just got these CPI numbers from the Excel file that we looked at in the last video. Putting all this information into our formula, Goldfinger made a box office of $124.9 million in 1964. We multiply that by the CPI in 2019, which is 107.86, and divide it by the CPI from 1964, which was 13.09. We can see that there's been a whole lot of inflation that's happened over that 55-year period. Multiplying this whole thing out, we get $1,029.2 million, which is just over $1 billion in 2019 money. In the fourth column of the table, I've gone through and done this calculation for 3 other movies, Live and Let Die, GoldenEye, and Casino Royale. Did the same adjustment based on those years' CPIs to 2019 CPI, and we can see that while it looked like Casino Royale made a lot more money than Goldfinger, once we have adjusted for this inflation, we can see that the 1964 movie was actually the highest earning of the 4. If you want to get a little bit more practice doing this calculation, then I encourage you to go and verify the box office earnings in 2019 dollars of the other 3 movies. The CPI is not just useful for comparing the cost of living across time. We can also use it to compare the cost of living across regions. The Bureau of Economic Analysis also calculates what they call regional price parities for various states and metropolitan areas. The average price level across the entire country is used as the base. A regional price parity, or RPP, above 100 indicates that a state has a higher price level than the average of the entire country. An RPP below 100 indicates a state has a lower price level than the nation as a whole. In our Excel file, I've included the RPPs from 2018 for all 50 states and the District of Columbia. I've sorted them in descending order so we can look at the most expensive states to live in, which are Hawaii at 118 and New York at 116. Right here in the middle, we see the United States at 100. So this means that all the states above that have a higher cost of living than the country as a whole. Making that comparison, we can see that Hawaii has about an 18% higher cost of living than the national average. Looking at a few other states, we can see that Massachusetts has about a 10% higher cost of living than the country as a whole. And if we go down towards the bottom, we can see that South Dakota has an RPP of about 88, meaning that the prices are about 12% lower than the country as a whole. All the way at the bottom, we can see that Arkansas is the cheapest state to live in, where the prices are nearly 15% lower than the national average. One of the biggest reasons for the differences across states in the cost of living is the price of services and housing. It's easy to transport goods across state lines, but it's not so easy to transport a house across state lines. For that reason, goods have a relatively lower impact than housing and services. The last application we're going to look at for the CPI is calculating a real interest rate. Inflation affects the rate of return of saving money. Suppose we were to save $1,000 in a bank account. Suppose also that that bank account has an interest rate of 10%. This means that in 1 year, we will now have $1,100 instead of $1,000. Because of inflation, the $1,100 we will have in 1 year is actually worth less than $1,100 in today's money. And so we are not actually getting a 10% increase in our purchasing power by saving this money. Inflation is going to reduce that. In an extreme case, if inflation were over 10%, we would actually lose purchasing power by saving money in this 10% interest rate bearing account. The interest rate that you get from your bank is called a nominal interest rate. This does not take inflation into account. The real interest rate does take inflation into account. We calculate the real interest rate using the Fisher equation. The Fisher equation gives us an approximation of the real interest rate using a very simple formula. The real interest rate is approximately, and that's why we use that squiggly equal sign, the nominal interest rate minus the inflation rate. Like I said before, this formula is approximate, but if we have relatively low numbers, it's pretty accurate. For example, let's suppose that the inflation rate was 4%. This means that our real interest rate is approximately 10%, which is our nominal interest rate, minus the inflation rate of 4%, which is going to be 6%. There is a more sophisticated equation that we can use to more accurately calculate the real interest rate, but this will suffice for our purposes. This has been an introduction to calculating the cost of living using CPI. If you have any questions, feel free to let me know. Thanks for watching.